Hello and welcome to another episode of Kuvera Insights, where we talk to industry experts on how to best manage your wealth. Today we have a special guest from Aditya Birla Sun Life, Abhishek Singhal. Abhishek has been in the industry for 19 years. He has had rich experience in asset management, investment advisory, across business development, and new products. What's really interesting about his profile is that he heads passives and product initiatives. So a lot of the product innovation that you see that will come out or that is coming out in the AMC industry, he's playing his part in doing that within Aditya Birla Sun Life. Abhishek completed his bachelor's degree in commerce with honors and holds a master's in business administration. Welcome, Abhishek. How are you today?
I'm very well. Good morning, and thank you for calling me here, Gaurav.
Let's start from, what can an investor expect, right? So today, a fixed income investor has access to liquid funds on one, and then you have ultra short, then you have gilts, which is your government of India, and then you have corporate debt. You also have a PSU ETF, PSU bond ETF, right? And then you have corporate debt where you are taking both credit and interest rate risk, right? In this spectrum, where will these indices lie? And from a very, in a very simplistic, way, what can an investor expect?
Sure.
What kind of risk reward are they looking at?
Think of it as a ladder. Yeah. Every step that you take up, you're taking slightly higher risk, but for every step up that you're taking in terms of risk, you're getting more reward, which is in terms of yield.
Yep.
To draw a parallel, if you recall from our childhood days, the most basic product that everybody was taught was a savings bank account, or what we call as CASA. CASA, you can put money today, pull out money tomorrow, assumed to be very, very safe. What is the return that you get there? Maybe about 3%, if 2.5%, I think, in most of the banks. One more step up, you go to bonds, or let's say FDs. FDs, 1 year, 3 year, if you get out early, you are paying a penal clause or a penalty or something. But typically you will get a 4% there. You take one more step up, you get into a post office deposit or a corporate FD, you'll probably get about 5% or 6% return there. And then higher you go to something like a chit fund or some sort of an unorganized deposit, 9%, 10%.
Or you won't get your money back.
Now, equivalent to that, in the mutual fund parlance, you have the safest, which is a liquid fund overnight fund, which will give you maybe about 3%. Then you have something like a short-term fund or a banking PSU fund or a money market fund, which will perhaps give you somewhere in the range of 4% plus minus. And then you have an income fund, or you have a government securities fund, which will give you a 6%. So every time you do a step up, you get term premium or you get credit risk premium. The highest end, of course, as I said, the riskiest end in the unorganized market. Here you would see something like a credit risk category, where you are buying more and more of credit risk. So if we were to place indexes here or passive funds here, because it's just the starting of this passive fund industry here on the fixed income side, we are currently playing in the very safe zone. We are experimenting with only AAAs. We are experimenting with only government securities or quasi-government securities, and trying to create something which is equivalent to FDs, trying to create something which is equivalent to these 4-5 year bonds, and also delivering something at extremely, extremely low cost. So typically you will get these index funds at maybe 15, 20, 30 basis points of expense, but delivering a little extra. So you basically buy and hold. If you want to get out, of course, you can. Unlike an FD, where you have to pay something extra or some penal clause, here you don't pay anything.
Fair enough. So in an investor's portfolio, what role do you see this product playing? And in comparison to where the active debt fund market is, how quickly do you think passives will be adopted on the debt side? Actually, you can answer both questions. How quickly do you think passives are being adopted on the equity side? And then, put on your futuristic glasses, and how quickly do you think passives will get adopted on the debt side? They're both very interesting questions for both of us.
Hey, why these are kind of two sides of a coin, but all joined from one side.
Right.
I think the disruption that we saw on the equity side, it will be a faster disruption on the fixed income side. On the equity side, in 2015, when EPFO, agreed to start putting in, or when reforms happened in labor ministry, and EPFO was told that up to 15% you have to start putting in equities. It started, that domino in the equity side for ETFs. At less than half a percentage point of overall mutual fund AUM, then today passives on the equity side alone contribute more than 9% of total AUM.
And this is from 2015 to 2021. In the past 6 years, passives have grown from 50.5% of total AUM to 9% of total AUM.
9% and plus.
Yeah. And growing fairly fast, right? Yeah, the growth rate, exactly.
The growth rate is over 60% compounded.
Wow.
While the industry has grown, of course, very rapidly, but industry has grown at roughly about 25-26% cap. So you can see the adoption rate. It's still largely more institutional adoption. It's still largely more HNI. But we see that, new age distribution has cropped up, and kudos to you guys, Gaurav. The new age, the digital players have adopted it so quickly and taken it to masses so quickly. People find it simpler, they find it easier and more profitable, in fact, because every penny saved is a penny earned. And, every 1 percentage point drop in expense is a compounded annualized growth in your own portfolios. So on the equity side, we saw a disruption largely on two accounts: one, cost, and two, maybe returns. But it's a sort of a seesaw thing. As phases pass, active will come back. But if you look at the fixed income side of it, I think disruption has very quietly already happened. We used to have something called fixed maturity plans.
Yep.
This was kind of seen as a replacement for FDs. This was about close to about 2 lakh crore in terms of size out of a 13, 14, or maybe 15 lakh crore fixed income fund industry. In this last 9 months alone, the total size of this market has come down to less than 80,000 crores. And much of it has actually shifted over the last 9 months to 12 months into passives.
Right.
While the disruption has already started from one end, and again, it's more institutional led, the number of investors getting added is in excess of 2 lakh or 3 lakh per such large product. I think the first big one that we saw was driven by a government mandate, about a year and a half ago. It was still very early years. Experience was sort of mixed, but investors are willing to, take a bet. Investors are getting the advantage of liquidity. They are getting the advantage of very low cost. They're getting the biggest advantage of transparency. Fixed income markets, despite all the deepening reforms, etc., that we talk about, are still telephonic in India, by the way. Only the government segment is electronic. Equities became electronic trading way back in 2000, 2002. Fixed income market, the corporate bond, is still largely unorganized. It's still largely telephonic. So, and market pricing is still not very fine. With players like mutual funds, passive funds, etc., coming in, I think it will have that big impact, deepening of the market, as well as fair pricing coming in. So very exciting times ahead. I think investors will see this more as a replacement for their FDs. This is more like an open-ended FD that you're getting. You like the rate, you get in very, very safe sort of portfolios. You know what you're buying. It's not a black box that you're buying, and you know the yield that you're buying at indicatively.
Right.
Because the YTMs, because of the regulations, are published every 15 days by the mutual fund industry for all the portfolios. So you know broadly what environment are you getting in, what is the sort of yield on the portfolio, what is the remainder maturity, and you'll see more and more of these indexes coming.
Transparency and reporting standards, I think, anyways, in the mutual fund industries are really, really high, and I think that's a good thing. But this is fantastic, Abhishek. So, ladies and gentlemen, like this is Abhishek. He heads passives and product initiatives at Aditya Birla Sun Life. And the good news is that passives are coming on the debt side of the market as well, and not just for equity. I'm a very strong believer that passives have to play a large role in an individual's portfolio. So it's really good to see this development happening and happening really quickly. Thanks, Abhishek. Thanks for joining us today.
Pleasure's all mine, Gaurav, and all the best. We look forward to your participation.